but I would say anytime affordable strategy is a good deal to do. So, and in particular today it's great because, like we've talked about, it's a defensive strategy with still great upside potential, meaning we're not banking on rent increases to earn our return. And right now, like we just talked about, in the near term over the next couple of years, rent increases are going to be much more difficult to achieve than before. So I'll much prefer the business plan that isn't relying on rent increases than rent increases. It's just pretty straightforward.
Yeah.
So I would be hunting for those deals, and wink, wink, nod, nod. Hopefully we have one around the corner. So if you're not in touch with us already about investing, we highly encourage that you do so.
You know my email.
If you want that Rolex,
yeah,
Daytona, Panda for retail price, let us know.
Yes.
But not actually, because people have reached out to us saying, hey, can you help me buy a Rolex for retail? No.
It's hard, yeah.
That's not how that works.
Yes.
So anyway, that's what I would be hunting for. Obviously, I'm a real estate guy, so I'm going to be heavily biased towards going into real estate. People like to talk about diversification, but I like to talk about diversification because, as we've seen the meme of Bill Gates and Warren Buffett on the private jet, maybe they're heading to Epstein's Island, but the meme goes, when Bill Gates met Warren Buffett, Warren told him he needs to diversify and sell his Microsoft stock, right? And so he did. And at that time, I think his Microsoft stock was worth like 80 billion or something like that. And he diversified, and today Bill Gates is doing just fine, right? He's worth, who knows, 100 billion or something like that.
Yeah, I don't want him to have any more money, frankly, so I'm happy it happens.
He's doing great.
Maybe Warren did us a solid.
If he never would have diversified and just hung on to that initial share of Microsoft stock, he'd be worth like $1 trillion, right? Because if you have a good thing, go all in on the good thing. So diversification is great to reduce risk, but it is not necessarily the greatest way to actually achieve outsized returns. So when you find something that really works for you, and it might work for you because, like for us, we're in the real estate business, we understand it, we have unique insight, so we have a better propensity to do well by investing in real estate. You and I don't know much about investing in the stock market, so why would we go into that arena and think we could do better than the market? We're much better off deploying our capital in the stock market through a beta strategy, like investing in just a passive fund rather than trying to actively outperform the market. So that's just a little bit of a digression about diversification versus focus, but very much so believe in focus. And I would take the $1 million slowly but surely and deploy it into real estate strategies because I know it and because of also the unbelievable tax advantages of investing in real estate. This is the craziest thing, I think. If you are a high net worth individual, if you're managing a family office, you pretty much should only invest in real estate. But see, people like to get too smart for their own good. And so if you're running a family office and you have a $100 million family that you're allocating the capital for, you're thinking, well, we need to have a private credit allocation, private equity allocation, public equity allocation, real estate allocation.
Debt, yeah.
Yeah, all sorts of stuff. And it's like, listen, you're just diversifying all these outcomes and you're just going to go and get expensive beta everywhere. At the end of the day, the exposure between private equity, between public equities, and real estate, they're all very similar. They're all heavily correlated to interest rates. They're all heavily correlated to the prosperity of the US economy. They're not that different. You're actually not diversifying. You're just simply diversifying. So instead, if you develop and then here's the thing, public equities and private equity don't have the same benefits from a tax perspective as real estate. So
you can't 1031 exchange stocks.
No. So if you are a non-tax exempt investing entity, right? So if you're not a public pension, because a pension fund doesn't pay taxes. So for them, investing in real estate doesn't make quite as much sense because they don't benefit from the post-tax return. In many cases, through real estate, your post-tax return is higher than your pre-tax return. Now, what investment vehicle can say that, right? Because if you go invest in the stock market and you make 10%, after paying taxes, you might only be left with 7%, right? In real estate, through the use of non-cash depreciation, right, through passive tax losses, if you can take that and offset other income in your portfolio, or if you're a real estate professional, you can use it to offset all forms of income in your life, you could actually achieve a post-tax return that is greater than your pre-tax return.